Hi everyone, and thanks so much for joining this week with our market update. We're going to get straight into it and look at the live prices. I am recording this on Tuesday afternoon, so US markets have opened. And as you can see, if you follow my pointer there, we are seeing a bit of weakness in US stocks. First time in 7 sessions. European stocks still powering ahead. Look at the FTSE there, really leading the way, along with the IBEX in Spain. So the FTSE is nearly up 1% today. So really extending those gains, and yet we've seen a bit of a pullback in US stocks. I don't think this is anything to worry about. We have seen a massive increase in US stocks just in the past month. In fact, I want to show you that chart. This is the S&P 500. It's a candlestick chart. It's daily. Goes back a full year. As you can see, we're above the 200-day moving average, which is the yellow line in this chart, and we're currently hovering around about that 5,940 level, just above there. So the next key level to watch is obviously that 6,000 level, and then ahead of that, we've got this big massive level, which is of course the 6,147 level, which is the record high from February. So that's a key thing. I just want to show you just how extensive this move has been. Just bear with me now, guys, for a moment, because from the intraday low on April 7th, when we reached the nadir for stocks, to the high, we have risen 23% in the S&P 500. So when you see this small pullback like we're experiencing on Tuesday afternoon, you put that into some context. It's completely normal to have some sort of pullback. Look, all these white candlesticks, they're up days. This has been a very long and progressive rally to the upside. So a huge amount of momentum is there. We think this is a pause. We don't think this is a change in direction. So again, we're just looking to just take a breather and maybe consolidate for a little bit. Now, what's been really interesting is that we've seen a break in US asset prices. We've seen this big recovery in US stocks, and I'll show you a NASDAQ chart in a moment as well. Compare that to the dollar. The dollar has really been in the doldrums. Likewise, UK Treasury yields, they've been rising at the same time as we've seen these fall. So let's jump straight into the euro here. Euro is actually in a bit of a consolidation pattern, but it has managed to pop above 112.50. It's not really been able to gain too much, but as long as it remains above that 111.20 level, which is the 50-day moving average, then we think we're going to be supported, and it actually supports and will actually support a stronger recovery in the euro. For now, the euro is really being contained, though, against the dollar. Although we remain constructive on euro dollar, it is being constrained by the fact that the ECB is expected to cut interest rates again, in June, and no other main central bank is expected to do so. So that's definitely keeping a lid on the euro. So there's ECB rate cut, that rate cut that's expected in June, is keeping a lid on the euro. Now let's look at the yen. Dollar yen had made that false break above 145 earlier this month, and since then has just been on a real downward spiral, as you can see. Now we sliced through that 50-day moving average at 146, currently trading at 144.80, so we've even lost that 145 handle. But you know, we've seen a much more tepid recovery in dollar yen, certainly compared to what we've seen with US stocks. Today, we're kind of consolidating a bit, but I still think that looks like a pretty strong downtrend where we're coming from. And I think that we could definitely test the waters around 142.5 there, which were the lows from the 7th of May, so just a couple of weeks ago. So it doesn't look too constructive on dollar yen. And then let's look at cable as well. Cable is looking very, very strong, actually. So it looks like we're kind of we're close to these cyclical highs. It's pretty much flat on Tuesday, but we are trading 133.60, 134.40-ish. That is a high of the year so far. So they really are. We're less than 100 pips away from there, just 80 pips away from those highs of the year now. Pound looking very, very strong, being obviously better than expected growth. We've also got we've got trade deal, and we've got that trade reset with the EU. All of those are just opening people's eyes back to the possibility of the pound and the UK as a centre for growth, for productivity, and to do business. Because remember, that EU reset was really important because we have a 400 million plus market on our doorstep. We need to improve those relations with the EU, and that's hopefully what's going to happen with this reset. So that's been really interesting. I just want to scroll back to something else. This is bond yields. Bond yields have been really, really important this week. I just want to show you where my pointer is. That is all a sea of red. That means that bond yields are rising, bond prices are falling because those things move inverse of each other. Bond yields very pronounced the increase in Canada and in the United States. Canadian inflation surprised on the upside today. That's explaining that big surge higher in 10-year yields in Canada. And then we're seeing a 5 basis point increase in the US yield, slightly less for Europe, although the UK is kind of moving a bit more in lockstep. We saw massive increases as well today in the 30-year yield in Japan. Just showing you that was up 12 basis points. We're up 10 for Canada, and yeah, much smaller gains actually for the UK today on that long end yield. And let's look at the shorter end yield as well. As you can see, a bit higher there in the UK. We're still pricing in some of that good economic news, pricing out the prospect of rate cuts as well. The US, interestingly enough, we had 2 key Fed members speak yesterday and just really rule out the prospect of a rate cut before September. That's not having too much of an impact in these in the US 2-year yield. But these yields are on the rise. They are on the move higher. And what does that mean? That can make it harder for equities to rally. So we've got a weak dollar, we've got rising yields, and yet equities are rising. It's no wonder, and yet equities have had this massive run for the past month. So it's no wonder really that equities are taking a pause here. Remember, investors can get very, very nervous when the currency doesn't move in the same direction as yields, because it suggests there's fiscal concerns there, of which we know there are in the US, because the US had another credit rating downgrade on the end of last week. That impacted markets yesterday. I think that's really worth noting. The other thing that I want to show you is the breadth of the market. Now, this may look like a real headache, this chart, whenever it comes up, but it basically gives us lots and lots of new information, which I will be writing about over the coming days. But it just shows you the number of advances and decliners. So today, you are seeing pretty broad-based decline there. 350 members of the S&P 500 are down against 150 on the upside. So again, a ratio of nearly 2 to 1 on the NASDAQ falling as well. So it is a bit of a broad-based decline there, and we are just seeing probably the fizz come off. But in terms of these moving averages, what are the percentage of companies that are above their moving average? Well, in the Dow Jones, that's over 60%, over 50% in the S&P 500, and just 33% in the NASDAQ are over their 200-day moving average. That compares with the 70s for the Eurostoxx index and the FTSE 100. What does that mean? That, to me, means that we've got some space with the S&P 500 and the NASDAQ to play catch up with these European indices. We'll be looking at that more closely in the coming days, so do watch out for that. But it does suggest to us that we have got quite a lot of, we've got more potential for upside, and that this is just a bit of a pullback. I want to show you NVIDIA as well, because NVIDIA has been so critical to this market rally. It's up 30% in the past month. Oh, just bear with me, guys. Sorry, just pulling up that chart, the NVIDIA chart, just to show you really how far and how fast it's gone. Sliced above that 200-day moving average at 125.70. That is now very much in the consolidation pattern. So it hasn't been able to make any higher highs after that high that it reached on the 19th. So at the start of this, the end of last week, sorry. So we really have seen a bit of consolidation coming in to NVIDIA. Now that is a little bit problematic for the S&P 500 in the very short term. The reason why is because NVIDIA is such an important part of the US stock market ecosystem. And if it's moving sideways, then you can pretty much guarantee that the rest of the index is as well. It doesn't mean that the rally is over or the recovery is over. It just means that it's taking a pause. We've got NVIDIA results out next week, so we need another driver to push forward these markets and the S&P 500 into new record territory. Now, I am going to leave it at that. We have a lot going on in markets. We have a UK CPI report due on Wednesday. That'll be really key. Higher inflation is expected, but if we get an even bigger than expected inflation number, then that could actually weigh on the pound, because it could give people some fears about growth worries when they've just been so good for the UK. So always worth watching UK CPI. The other thing that we have going on as well is the start of the month. So the May PMIs, they're all coming out towards the end of this week from Thursday onwards globally. Definitely worth watching. How have tariffs or the lack of tariffs impacted growth? We think it's making growth very, very lumpy. But one thing I would point out, volatility is still quite low. So we haven't seen an uptick in volatility, even though we've seen the stock market recovery rally pause. So that is still constructive on risk. The dollar, not so much, but for now, US equities are doing well. Thanks everybody for joining, and we'll speak again soon.